Okay, great. I decided to make this third part. This is a really short part, but it's just kind of what brings all this together. So what we have here is, I just want to explain how it actually works in the end. So if you turn to, please, you need to turn to page 228 of your textbooks. It's kind of how we finally tie this up. So I've talked about this idea of writing off the bad debt, which is part one. You write off the bad debt or the irrecoverable debt. That's the first thing we do. So for example, if I have trade receivables of 10,000 and I have an irrecoverable debt of 1, I would write that off first. So that table is so important. Write off the bad debt first. Then we have what we call specific allowances. So for example, we know in particular that there's one client who may not pay us, if you like. So we make a specific provision for them. So we have that, and we deduct that as well. When I say deduct, we just kind of deduct that because we see I'm trying to do what I did in just the previous video about your provision. So we always calculate this general provision that I was talking about in the previous video of 5% or 6% after we have taken off, because it's really based on what debts we have left, right? After dealing with write-off bad debt and specific, then we do the general. So let's just look at that page. I just want to clearly state what it's telling us. Write off the bad debt first, create the specific provision, find out what's left after you've deducted both, and then you may calculate the general provision on that. So very quickly, I want to do that example on page 228 of your textbook. There's a question there that just to kind of tie this up very quickly. So it says that a business has receivables, trade receivables of 356,000, and of which 16,000 are to be written off as bad debts. I'm going to use different colors, telling us clearly that 16,000 pounds of this is a bad debt. Then it tells us that after this, make a specific allowance because we think there's a debt of 2,000 that we're not quite sure about, right? We think we might not get it. And then it says the rest, do a general allowance of 4%. So first of all, what's it telling me to do? You can look on page 229, take off the 16. That's the irrecoverable. You're not getting that back. It's gone. Then, in the process of doing this, once you do that, you have 340,000. Then take off the 2,000. Just so we can calculate our our general provision. So I now have 338,000 left, right? Now I can do 4% on this. When I do 4% on this, I will get 13,520. So my general provision is this. My specific provision is this. So my total provision, my doubtful debt provision, is the sum of this two, which is 15,520. Now, coming back to what I was saying, 15,000, is this idea that I already have, it tells us we have a provision of 12,000 already. We have already hit our income statement over the years with this potential payable liabilities Olga of 12,000. Now someone tells us that we actually will have to pay maybe 15,520 in the future. Well, all I have to do is just top that up, right? Provision for doubtful debts, allowance, if you like. Well, this is provision for doubtful debts or allowance for doubtful debts. The key point is, you know, this is the liability and you have 12,000 on the credit side. So all I put through my income statement is just the difference of 3,520, 3,520. This goes to my income statement as an expense. Transfer to my income statement as an expense, right? And then therefore my balance carried down, my carried down balance is now 15,520. That comes down, brought down 15,520, right? And that's how we deal with this. Okay, great. Now the last thing I'm going to ask, just to talk about very quickly in this video, is what happens if in the previous period, you've written off a bad debt. It's gone, and then suddenly, maybe a year and a half later or whatever, even just to make it that distant, even 2 years later, the guy resurrects, or the people who had bought the company say, oh, listen, this person owed you some money some time ago. Oh, you had written it off. We're sending it back to you. You've got the money here. They send you a check. As soon as you see that, straight away, you know that, I received a check. It could be for 5,000. So it's a source of income, technically, right? So we just call it bad debt recovered, or irrecoverable debt recovered. Yeah, bad debt recovered. You've recovered. It's come. It's a source of income. £5,000. That's what's happened. You've received money. It's a check. So we must debit bank and credit the source of income. Now, this would, of course, because it's a source of income, it just sits underneath your gross profit. There are a couple of them like that. So it's called bad debt recovered or irrecoverable debt recovered. You record the 5,000 underneath your gross profit. You record that there and you add that on as a source of income. Cool, great stuff. So yes, 3 videos on chapter 9. It's a long one, isn't it? And we'll what's the word? We will carry on. Yes, then that kind of ties up chapter 9, and we're moving on to the next couple of chapters. Okay, great stuff. Thank you. See you then.